And just like that today, we gave it back about half of what we had captured as far as lowering interest rates the day before. But the good news is it was basically data driven, and that's exactly what we like to see. What's going on, y'all? My name is Kevin Weedmark, aka The Mortgage Mouth, bringing to you an episode of the Daily Dose. Very quick 2 minutes of what happened in the marketplace, so make sure you hit that subscribe button. So a lot happened today. Number one, early in the morning, we had GDP come out, and GDP blew away forecasts. And what we saw is 10-year treasuries actually sell off quite significantly, pushing interest rates higher. But once everybody dove in, the knee-jerk reaction was over, because what it really showed was there was a component showing that domestic purchases are actually contracting a little bit. So that GDP number, even though it was great, we're seeing that on the domestic side, we're pulling back a little bit. And once again, if you recall last quarter, right, the GDP was horrible and it was all blamed on tariffs. So why not blame it on this one? The big indicator and what we saw in the afternoon and why we saw the rally actually correct itself a little bit was because PCE prices were up a little bit. And if you recall, we have PCE coming out tomorrow. So if that's any indication of what that number is going to be, inflation could come in a little bit on the higher side, a little bit above forecast, once again showing itself sticky. And then lastly, we knew the Fed wasn't going to do a damn thing, but the biggest thing that we saw, kinks in the armor. That's right, y'all. 2 members dissented on the Fed. Haven't seen that, I think I read, since 1993. Major news seems to be being blown off, but what it's showing to me is that people are getting to members of the Fed, and it's starting to get political in nature of why they should make a move sooner rather than later. All right, y'all, I'll be coming to you now tomorrow with another episode of the Daily Dose. Cheers.